resisting my computer commands, and that's not where we want to be here. So I apologize. Oh, there you go. Now okay. I got a delayed reaction, which typical, I guess, of this sort of thing. Start off with the point that we have to look at what's going on in the economy because it will affect the insurance environment. And I want to start with a statement that the chair of the Federal Reserve made a couple of months ago, but it's, I think, still valid. Basically, he says the path of the economy will depend significantly on the course of the virus. Okay, no big deal. And the virus basically will affect, he says, a lot of economic issues in the near term. And here's the most important part of this. It said it poses considerable risks to the economic outlook over the medium term, which for them means a couple of years out. And in fact, yesterday, the latest statement by the Fed suggests that they will keep interest rates exceptionally low, possibly for 3, 4, or 5 years, if needed, to deal with the impact of the virus. So this is a chart showing you the rate of change of the US economy going back to 1971, so basically 50 years of change. You can see something of a downward slope, that is to say a slower growth rate, including two fairly significant drops below zero, one in 2009 and the other one in 2020. Those, of course, were the two, one, the current recession and the previous most recent recession, so-called Great Recession. And then the numbers for 2020 and 2021 are forecasts. We'll get to what that really means in just a minute. But let me show you the impact of the economy on net written premiums for the property casualty industry. There are three hard markets. They're obvious in this chart. And then there's a fourth high increase in net written premiums in 2018. That really wasn't a change in rates and conditions, but rather a change in the use of reinsurance, which was caused by a change in the tax law. So if you exclude those four instances, what you see is a pretty good track of the net written premium growth with the nominal, that is to say, not inflation adjusted gross domestic product. So if you want to know where the insurance industry is going, a good first step is to figure out where the country's gross domestic product is going. This is quarterly real growth, that is to say inflation adjusted growth. Each quarter is measured and then converted to an annual rate, which is what that means is we take the growth rate for the quarter compared to the previous quarter, and then we assume that it's going to happen at the same rate for the next 3 quarters, so you got a full year's worth of that. The result being that in the second quarter of 2020, you get a minus 31.7, which is, it's really more a quarterly measure of about 8 or 9%. That is then repeated for 3 more quarters into an annual number. So just about nobody believes it's actually going to happen this way, but this is the conventional way of expressing this. So that's the history. Here's the forecast. The forecast I'm using comes from an organization called Blue Chip Economic Indicators. It's a widely respected organization that surveys 53 econometric forecasts every month and publishes the results. And what they do, one of the nice things I think they do is that of the 53 forecasts, they'll take the 10 highest and average them, and the 10 lowest and average them, and then compute a median or a central tendency. That's the 3 lines I've got graphed in here to show you there's quite a wide range of legitimate forecasts of what's going to happen. Now, this is the forecast for the third quarter of 2020, the one we're almost done with, actually, 2 weeks to go, was published about a week ago. And you see an incredibly wide variety of forecast numbers for this quarter, and a shrinking variety, but still quite a bit of difference for the next quarter and the rest of 2021. Again, these are changes from quarter to quarter at an annualized rate. So no one really expects a 32% increase in GDP for the third quarter. What they expect is about a 7 or 8% increase, then multiplied by, 3 more of the same thing. Quite a wide range of possibilities. Even the pessimists think there's going to be quite a bounce back. But here's what's really being talked about. This is the actual real GDP, that is to say, through the second quarter of 2020. That's the $17.28 trillion number. Those are all historical numbers. The numbers to the right of that, beginning with the 18.238, that is a forecast under the blue chip system. And so the great increase that I just showed you, that might be as much as 32% or so, really is from 17.2 trillion to 18.2 trillion. That's about a 5.5% increase. You see that from then on, the expectation is that we will continue to grow the economy at a moderate rate. But also note that at the end of 2021, the last quarter of 2021, we will be arguably at 19.2 trillion, which is not even as high as we were in the fourth quarter of 2019. So you'll be hearing headlines of growth, and we will in fact be growing, but it's like we went into a Grand Canyon in the second quarter of 2020 second quarter, and we're slowly climbing out of the Grand Canyon, and we won't get back to the rim until the end of next calendar year. Just give you an idea of how difficult it is for forecasters. I mentioned a minute ago the blue chip variety of forecasts for the third quarter of 2020, and I've reproduced them here, the 15, 24, and 32. But here are some other individual forecasts. The New York Federal Reserve Bank is one of those down at the 15% guess. Goldman Sachs, respectable, accurate, generally speaking, forecasters think it's going to be more than twice what the New York Fed is predicting. GDP Now is a computer program the Atlanta Fed puts together. So we're talking about an incredible variety of forecasts for a quarter that ends literally 2 weeks from now. We should know most of what goes into that quarter already, but it's very hard to measure these things under these conditions. One of the reasons why we will be growing fairly slowly is that even though people have money to spend, they're not spending it. The blue line at the top is disposable personal income. That's personal income after taxes. And I graphed it starting in November of 2019. And you can see that we started out at $16.5 trillion. We pretty much stayed steady with that number until March of this year. And then with the CARES Act, we put $2 trillion worth of, $2.5 trillion worth of purchasing power in people's pocketbooks, from 16.5 up to almost $19 trillion. But the orange line is spending, personal consumption. And that stayed pretty much the same until February. It dropped by about $1 trillion in March, because in the last 2 weeks of March, people realized that they could be unemployed for a long time, or even could become unemployed if they weren't already losing their jobs. And then in April, even though their income shot up because of federal government stimulus, spending went down by almost $2 trillion more, down to $12 trillion. And it stayed down even in July, the last month I have data for. We're in a spending pattern below March and February and not March, February and January of this year. So people have the money to spend, but they're saving it, and you can see the saving percentages in the box to the left. We went from a typical 7 or 8% saving rate up to, in April, literally 1/3 of all the money they had was not being spent. And the latest number is still quite a huge saving. And that, again, one would argue is quite sensible, given the economic uncertainty that many people are seeing. Business spending is also down. This is annual numbers. You can see a bit of a downward trend from 2018 to 2019, from 6% down to 2%. And then the forecast from Blue Chip is somewhere between a 5% and a 9% drop this year in spending on what it's called non-residential fixed investment. And then most forecasters are seeing a rebound, not a very strong one, in 2021. Non-residential fixed investment consists of 3 types of spending by businesses. The first is what's called structures, buildings, that is to say, that's the blue line in this graph, which goes all the way back to 1947. And you see that pretty much since the mid-1980s, that number has been close to 3% per year. Recessions tend to force it down. You can see that in many of the recessions, which are the light blue shaded areas. But the latest reading we have is very close to a 3% increase in structures. The red line is equipment, and that goes down in recessions also, and you can see a clear downturn in the circled area to the extreme right of this graph. The one thing that seems almost immune to recessions is the gold line, which is what's officially called intellectual property. It's basically software, and it shot up so far in this recession, and has in fact either increased or stayed somewhat flat in most recessions. So that's what's, to the degree there's an increase going on here, it's the purchase of software in these days that is being conducted. Where's the stock market going? Well, one way to guess is to take a look at corporate profits. Corporate profits is not a perfect indicator, but indications have been that the corporate profit changes have been modest. Major shrinkage expected, especially in industries that have been very hard hit in the current recession. Obviously, apparel, travel, recreation of one kind or another. And then most economists are seeing something of a rebound, again, not all by any means, in 2021. In terms of where people are spending money, I've got 2 categories listed here. One, the blue line on the top, is new motor vehicles, and that was rising fairly healthily in most of this history going back to roughly a decade ago. But the last 2 quarters, 2020 quarters 1 and 2, which are graphed at the very right-hand side here, show something of a steeper plunge than might have missed. On the other hand, things you put in your home, furniture, major appliances, TVs, and computers, that green line is virtually rising or at the worst flat in 2020 so far. So in terms of people buying homeowners insurance, they need to look at the limits for personal property, which probably are at least going up modestly and maybe substantially. Other personal consumption expenditures in terms of durable goods, the rising blue line in the middle is boats, aircraft, RVs, and motorcycles. And that in the last 2 quarters in the current year, a remarkable rise. As you can see, people are, I suppose, taking their vacations in vehicles of this kind. That's because, I guess, in your RV or in your boat, You're not going to get the virus from anybody else unless they've passed your entrance requirements. In contrast, the green line at the top, jewelry and watches plunge in the last 2 quarters. And also, surprisingly to me, spending on telephones dropped dramatically in the last 2 quarters. So I'm not sure what accounts for that, but we're talking about a roughly 25% drop in telephone spending. Maybe they're waiting for the latest Apple iteration to come out. This is not surprising at all because most of these activities that are summarized in this one line have been closed for most of the last 6 months. And for spending for the first second quarter down literally almost 80% compared to the end of 2019. Here's one that kind of surprised me. Spending on transportation and warehousing in commercial sense is way down. And inland marine premiums, which generally speaking track this kind of spending, are also down significantly. Inland marine premiums, direct premiums, this is, down not as sharply as transportation and warehousing, but see, I thought all the online purchases would actually have this increase in the last 2 quarters rather than plunge the way that it has. Maybe more of this is transportation than it is warehousing, but nonetheless, we're looking at an economic driver that, reasonably speaking, is a good proxy for the direction of inland marine direct premiums. In terms of residential behavior, the black line in the graph that's rising is increased availability of apartments in central business districts. So people are leaving central business districts, and the brown line over on the right-hand side of this graph heading down towards the 5% number, that's availability of apartments in suburbs. That's where people are going. They're moving from cities out to suburbs, even when they stay in an apartment, as opposed to buying a house. Many of them, particularly if they've lost their jobs, obviously can't find ways to buy houses. But nonetheless, there's some major changes going on in terms of where people live. In terms of property insurance, generally speaking, looking at both office, retail, and industrial, I've circled the most recent quarters in terms of vacancy rates, and you can see that in all 3 cases, vacancies are rising. We're going to have empty stores, empty offices, empty industrial buildings, and rising vacancies, as my caption says, could mean potentially higher claim frequency and severity because nobody is there watching to see whether vandalism or burglary or of what's there, or fires or water leakages or any of those things that could cause major claims might be stopped early if people are there, but probably won't be if nobody's watching carefully. I want to take a look a little bit about what's going on in the labor market. No surprise, the second quarter of 2020, a major disruption of people employed, 13.281 million people less employed than in the previous quarter. This is not at an annual rate, I should say. This is just the number in that quarter that left employment. And what we normally see is in this graph, the so-called headline unemployment rate, that's the orange line. As you can see, it briefly bounced up to over 14%, back down to 8.4% in August, the most recent reading. But economists don't like to look at that number because it really doesn't count everyone who's unemployed. If you're unemployed but you haven't looked for a job in the last 4 weeks, you're not counted as unemployed in this measure. The Bureau of Labor Statistics measures unemployment in 6 different ways. We like to use the U6 measure. That's the most comprehensive measure. Anyone who does not have a full-time year-round job and wants one is called unemployed in U6. That's now 14%. It was up to 23% at one point. But even at 14%, 1 out of every 7 people in America who wants a full-time year-round job and doesn't have one, 1 out of every 7 people is in that status. So that's actually worse than the headline number ever was. Even in the Great Recession, the worst the headline number was 10.1% briefly. The U6 is at 14.2 and was at 17.5 at the worst of the Great Recession back in 2009. If you look at part-time and full-time employment, for most of the past 8 years, full-time employment, those are the orange bars, basically rose more or less every quarter up to from 116 million up to 130. We're now back to 116 million full-time employed. The blue line is part-time employment. As you can see, that was pretty steady for this entire period. More or less in the 27, 28 million category, and it plunged in the second quarter down to 21 million. So we have both part-time and full-time people unemployed in the second quarter of this year. It's an interesting thing where these numbers come from and what generates them. One thing to look at is the civilian labor force. This is all the people who are available to work, including all those who are working and all those who are not. And in the most recent study, you can see over in the shaded area on the right, this is the drop off in the number of people in the civilian labor force. Went from 165 million roughly down to 156 million or so, and then recently fairly quickly back up to 161 million. But what I think is one of the most important parts of this is that the share of Americans who retired when the current pandemic started, rather than remain in the labor force, shot up 7 percentage points. Millions of people who were potentially laid off said, you know what, I'm never going to get a job at my age. I'm basically, when the Bureau of Labor Statistics surveyors came around, they said, well, I'm really retired. And so if they did not so declare themselves, the civilian labor workforce would have been larger by several million, but the number unemployed would have been larger by the same several million. So the unemployment rate would actually have been higher than was published. And the 8.3% for the headline number would probably have been in double digits. So the numbers, understanding the numbers takes a little bit of internal math to get a picture of it. Employment rates in 2020 differ by wage levels. This chart shows you that for people earning $60,000 and above, at the moment, after a substantial dip in April, this through the end of July, only 1.6% lower than what the employment levels were back in the beginning of the year. In contrast, people earning $27,000 a year or less, the lower paid people in this country, employment for people in that income category is still 16% below what it was in January. And you can see that's an increase from where it was in April, where the level of employment for this group was down as far as roughly 33%. The other part of what we need to look at in terms of the effect on the property casualty industry is what's going on with interest rates. And the reason we look at interest rates on the investment side of things Take a look at the dark blue line here. That's the combined ratio using the scale on the left-hand side. The light blue line is the 10-year government bond yield, and you can see that with rare exceptions, these two things track each other. So if the bond yield is trending down, as you can see it has been since basically 1979, the combined ratio as a general matter has been following. A couple of years in which it shot up, but we'll talk about why that's the case in a bit. But everybody knows, basically, if you've been paying attention to the business news, that 10-year US Treasury note yields have been going down. What we may not realize is that they have been below 3% now since 2012, going back into 2011. So if you bought a 10-year bond in 2010 or 2011, and you were able to get 3% interest, which at the time obviously was disastrously low compared to where it had been, you will be, and if the bond matures and you're going to reinvest that money, you're now going to be reinvesting it at not 3%, but actually much lower than that, possibly as low as 0.65%. And so you will be taking a major hit in your investment income, and you would be locking that 0.65% in for the next 10 years if you bought a 10-year bond. So a lot of insurance companies are buying shorter bonds in the hope that those will mature when interest rates are rising. However, yesterday, Chairman of the Federal Reserve, following the latest Fed board meeting, made it clear that they expect to hold interest rates at these extraordinarily low levels for quite a few years in the future. And that says to me that the current low level of 10-year notes is probably not going to even rise to 1% for quite a long time. Now you say, wait a minute, insurance companies don't invest exclusively in US Treasury bonds, and that's true. They invest in corporate bonds. So here's the Bank of America AA Corporate Index effective yields. These have not come down as sharply, but in fact have been settling for the most part for the past dozen years at the 3% rate. They've also plunged in recent months. The latest index in the Bank of America AA has been 1.42%. So once again, if you bought a 10-year corporate bond paying 3% and it's maturing, you're going to have to reinvest it at something like 1.5%, and that's going to be holding at that level for quite a long time. So the effect of this long-term downward trend in interest rates is that portfolio yields in property casualty insurance have been declining. Back in 2002, they were nearly 5%. In 2018, 3.35 just that 1 year. And then over to the right, I've got some quarterly numbers. 2019, 2020, first two quarters, 2.86 in the most recent quarter. And without doubt, we're expecting that in the future quarters, you're going to see further declines in the portfolio yields for the property casualty industry. Where are yields going? Well, back in early September, the blue chip 53 forecasters said that everybody said interest rates are going up. The pessimists said they're not going up very much, from 0.6% up to 0.8% by the end of next year. The optimists at the time said they would be going up from 0.9 up to 1.5%. But I suspect that when the October forecasts come out in a couple of weeks, all of these numbers will shift in a downward direction to some degree. So let's just take a quick look at where the industry is. Net written premium growth in most years has been in the 4% range. It was more than double that in 2018, but that's because a change in the tax law in December 2017 meant that reinsurance behavior was shifted so that a good bit of the reinsurance that had accounted for net written premiums was shifted from offshore to onshore, resulting in higher NWP. But we're now back to, if you will, normal behavior in 2019, and probably net written premium growth in 2020 when the data are in will be a lot closer to the growth in either 2009 or 2010, in part because the largest line, private passenger auto, is not growing at all. On the other side, catastrophic losses have, as you see in this chart, been increasing virtually every decade going back to the 80s. If you're guessing as to what 2020 is going to look like, I would have to guess we're talking about something close to what it was in 2018, maybe $30 to $50 billion. And of course, this is hardly over with. Hurricane season is just at the midpoint right now. Wildfires seem to be having their worst year ever. These numbers do not include flood losses. They're privately insured claims. And so we're going to have a pretty bad cat year this year. And based on the trends that you can see identified here, it's perfectly reasonable to say that on average, future cat years would probably continue at the 35 billion per year or worse. So the combined ratio is quite variable. You can see in 2017, the three highly destructive hurricanes pushed the combined ratio up to 103.7. In 2011, we had major tornadoes in April and May that pushed the combined ratio up there. Superstorm Sandy in 2012. But there were some good years that we didn't have quite the cat damages that we had in the years I just mentioned. So we have pretty good results so far in 2020 through the second quarter. But I think that the numbers I've just mentioned will bring that back to 100 and possibly even higher when 2020 is done. Underwriting gains and losses, I have data only for the first quarter of 2020, so I'm comparing it to the first quarters of prior years. And you can see that 2020's first quarter, in terms of underwriting gains, was the best year since 2007. Quite a remarkable turnaround, but again, I think when we get the rest of the data for the rest of the year, this year won't look quite as good as that situation does. Operating ratio, that's the combined ratio net of investment income. So what we expect to see most of the time is boxed in at between 88 and 92. Again, 2011, 2017, pretty much because of the claims that we had to pay, we're above that number. The quarterly numbers in green over on the right, we've had 2 quarters, including the second quarter, which were at the top of this so-called normal range. Others that weren't so bad, but I expect that the third quarter will be one of those that will shoot way past the 92 range. Investment gains come actually in 2 varieties. One is so-called net investment income. This is bond coupons and stock dividends, things that pay dividends all the time. And then the green parts are realized capital gains and losses. Since 2009, when we had nearly 8 billion in losses, these are all for the first quarter, again, because of the first quarter of 2020. But most years we have some realized capital gains, but the steady part of investment gains is the regular income from our bond portfolios and stock dividends. Insurer profits, again, come in 2 varieties, investment gains and underwriting gains. The net investment gains are in the blue here. They're pretty steady. The underwriting gains can be good, as they have been most years since 2013, or bad, as they were in 2009, 10, 11, and then 0 in 12 and 17. So if we're looking for sources of profits, it's the investment side of the house that does the heavy lifting. But we know from looking at investment yields, that will be challenged in this and coming years. Policyholder surplus has been, generally speaking, growing. It plunged in at the end of the first quarter of this year, but has recovered mostly because the stock market recovered. Policyholder surplus is driven to a significant degree by unrealized capital gains in stock holdings of property casualty insurers. And so that's what's caused the June 30th number to come back to about 837 billion. In terms of premiums, workers' comp premiums, that's the blue line in this chart, going back to 2007, have been decreasing, which is really quite remarkable because the red line shows you private employment. Employment's been increasing, so you would have thought that total premiums for workers' comp would also increase, but they haven't because the workplace has become a safer place. So that's a really kind of gratifying result. This is premiums for liability insurance, that's the orange line, and commercial multiple peril premiums, both going up, CMP going up more, even in the months of the current recession, as you can see the shaded area here. Oops, let me go back to that. Now, Wendy, if there are questions from the group, I think I finished a couple of minutes earlier than I planned. So we have more time for questions. If people have them, I'll do my best to come up with a plausible answer.
So yeah, I'm not sure if it'll be easier if people were to post their questions in the chat, because I think it might get clunky for people to speak up, but if you want to try to speak up, you can as well. I guess I was looking at the unemployment data, and I did see that, you know, it showed income demarcation, right, where you could see, you know, different income levels. And I wondered if you did it by industry, because I have this sense that certain industries were definitely more impacted than others. And of course, I'm interested, you know, what does insurance industry look like as opposed to some others?
Yeah, let me go back to that slide. Oops, I think, there we go. There's a website called tracktherecovery.org, which is a marvelous website. And that's where this graph came from. I don't show it on the graph, but over to the left, when you get to the website, there are a number of variables. In fact, the way I constructed this chart was by selecting, show me the employment rates for high income and low income people. And the high income they're defining as more than 60,000, low income is less than 27,000. But you can, instead of income levels, you can ask for industries.
Great.
I don't think it goes as finely grained as insurance. I think it might have finance and insurance, which would of course include the banking sector and the securities sector together. But it's dynamic in that not only do you get the reading as of the most recent date, in this case it's July 31st, but you can move your cursor from where the dotted line is and literally get a reading on any date you want in this chart. So it's extraordinarily powerful, very interesting. And this is not the only, there's, for example, a chart showing the number of small businesses that are open over the same time period that this chart covers, from January 1st, 2020 to, I think that one goes to the end of August, or the number of small businesses that are receiving revenue. So there's a wonderful array of information that you can get from tracktherecovery.org.
Sounds like a great website to check out. So we do have some questions coming in. So Alex is asking, how do you square slide 10 with the record unemployment? And so I guess you have to go back to slide 10.
Okay, let's go to 10. There we go. Well, I think some of the cutback in spending is people who are unemployed. They may have no income to spend, but that explains to some degree, I think, why the orange line dips the way it does. And as I said, I think that a lot of people, especially in the lower income categories, are probably doing whatever they can to scrape together. I mean, fortunately, there are some laws that forbid eviction right now from apartments and things, foreclosure on mortgages and so forth. So people who don't have money can still at least find a place to live or stay in a place to live. The measure of unemployment is tricky in part because there are, in many cases, the unemployment counts don't match what the stimulus efforts that are being made. So that's part of the problem. One of the factors that I think has to be considered is that gathering data these days by the government for official statistics is really tricky. To construct the unemployment rate, there are two different kinds of measures that the Bureau of Labor Statistics performs each month. One is they go to businesses and they say, how many people are you employing? The other is they go to households and they say, are the people who live here working? And if they are, is it part-time or full-time? As you might expect, there are a lot fewer BLS people going house to house and getting others to answer the door in this environment where people are afraid to connect with other people who might give them COVID-19. So gathering data is very much a less reliable, less comprehensive activity in this environment than it would be in so-called normal times. One of the things I was trying to get across in many of my slides is that we do have data for a lot of these things, but I have less confidence in the quality or accuracy of these data than I would in, again, so-called normal times. I'm not sure that completely answers the question, but I hope it raises some of the considerable doubt that everybody should bring to the numbers that are being kicked around.
Yeah. So another question, do we expect the large increase in the debt and deficit to be a drag on future growth?
I think the answer is no, at least for the moment, in spite of the fact that both the deficit and the total debt is at remarkable levels. Our debt as a percentage of GDP is now, I think, back where it was at the end of World War II and rising. But we still have a lot of unused capacity, and as long as the interest rates that the Fed keeps extraordinarily low or stay low, and to the degree that the debt is reinvested at these low rates, I think we can continue to carry it without too much penalty for a while. The trick, I think, is to grow the economy fast enough so that we can continue to, it's like when you buy a house and you take on a mortgage, the mortgage payments don't change over the life of the loan. If your income goes up, paying the mortgage off becomes easier. And that's basically the goal here, is if we can get our income up as a country, we can tackle even a growing debt rate. So the key, as I see it, is how well we can get this economy moving even faster than many of the pessimists and some of the so-called realists think that we are likely to be doing. Some argue that the way to do that is to conquer the virus of one way or another. Others argue that we should essentially ignore the virus and just get back to work quickly. But either way, I think the answer is we can handle the growing deficit and debt if we get the economy moving along at a sprightly pace.
So yeah, that sounds very interesting. There's another question about if there are projections on the effect of the election in November on industry expectations on growth. And so it sounds a little specific, but what do you think? Take a swing at it, right?
Yeah, it's interesting. It's hard to say. I mean, obviously, I'm not a political scientist, but I think that in terms of what people have talked about, certainly Biden has mentioned a number of infrastructure projects, which, to the degree that they put people to work and involve some private participation as well. That could be good for the industry in terms of providing insurance, and it also might actually get interest rates to rise a bit. And I haven't heard that much, at least not that I'm aware of, from the Trump side. But quite possibly we could have a similar sort of stimulus in the form of investments that, again, both the government and private industry would make. So it's not clear to me that one party or the other would be better for the insurance industry. We've done some analysis based on history going back to actually Harry Truman and looking at Republican presidents versus Democratic presidents in terms of the profitability of the property casualty insurance industry. And strangely enough, that analysis suggested that neither one was markedly different from the other in terms of the rate of profitability. So if history is any guide, the insurance industry will do what it will do regardless of who's president.
Thanks. And yeah, and it seems like it takes people to agree. And I'm not even going to go any further than that, right? Anything happening takes people to agree. So yeah, another question was if the slides are going to be available from the presentation. So can we send them out to the group?
Absolutely. And I'll post them on the Insurance Information Institute website as well.
Awesome.
So no, I'm quite happy to share them with anybody who wants them. It's the Insurance Information Institute's mission to provide materials that are helpful to the industry. And if anybody finds any of these helpful, I'm delighted to have that happen.
And there's one last question, and this is a curiosity. People are talking about this, but I don't know how much you might know about it. People are wondering, it seems that there is a gap between what people are spending and what they're earning. And so does that mean that we as a nation are saving more money, or do we have any kind of insights into what's happening to that money? Are people paying down debt or?
No, I do think people are saving money in one form or another. Not sure. I mean, some of them are putting it in the stock market, which may be reasons why the market is rising. But others, I think, are trying to make sure they can pay their bills and make sure that the bills that they have to pay are only the most urgent ones. One of the reasons why I spoke about the Federal Reserve and its effort to keep interest rates low. The other thing the Federal Reserve is trying to do is to increase the rate of inflation. And one of the reasons why it wants to do that is that if you believe that prices are going to be rising at 2 or 3% a year versus what they are now, which is rising at barely 1% a year, you might be willing to run out and buy some more stuff which would mean increased demand for the economy, and that would mean increased employment as providers respond to increases in demand for goods and services. So getting the inflation rate up is a real target for the Federal Reserve Board. And if they are successful, and so far they've been unsuccessful for the past 5 years or so, but if they are successful, that might help to get the economy going, get people back into employment that are not now fully employed. So there's that's another number to watch. I didn't spend a lot of time on inflation in this presentation, but as I said, that's a new target for the Fed. They used to say we'd like to get it to average 2%. Now they're saying we'd like to get it above 2%, mostly to encourage people to start spending now instead of putting it off.
Yeah. So when I hear those kinds of reports, so now I have my own question, like, what are the long-term impacts though of going up in inflation? Like I tend to see all this stimulus money going out and then also kind of loosening the reins on inflation. Do you think that there's risks there, systemic risks of doing both of those things?
Yeah, I think there is. There are, I should say, the plural. The question then really becomes, we haven't really been able to engineer inflation the way I think the Fed wants to. So that raises the question of, if there is successful in getting it going to over 2%, are we going to be able to control it when we want to bring it down again? And I think that's a pretty severe problem, because the last time we had inflation that was way out of control, the way that the Federal Reserve got it under control was to essentially create a recession. Not a good ideal answer, but that's probably pretty far in the future at this point. Inflation is very low. The Fed hasn't been successful in getting it up, and this is just a new target for them.
Okay. Well, thank you very much. We are coming up on the 11 o'clock hour. Really appreciate the presentation that you shared with us, though. I think we had a lot of good questions, and thanks a whole lot.
My pleasure.
Take care. Oh, and everybody, we're going to have a survey sent out to you all for the presentation. Thanks.